I was looking at the pre-market data, grabbing coffee this morning, and honestly, it feels heavy.
Heavy is a good word for it.
You know that specific feeling when the air pressure drops right before a storm? That is exactly what the S&P looks like right now. It's Friday morning, January 23rd, 2026. The bell hasn't rung, but if you look at the futures, we're essentially flatlining.
We are. The S&P is just hovering around 5,940, and the Nasdaq is, clinging to a tiny gain?
Yeah, almost a rounding error, 0.12%.
And don't overlook the Russell 2000. It's already lagging, down about 1/3%. You're right about the atmosphere. This isn't just a quiet morning. It's a classic Friday standoff.
A standoff between who?
You've got buyers on one side terrified of missing the rally, and then you have sellers on the other terrified of holding risk over the weekend.
So that's the mission for this deep dive. We've got a huge stack of institutional morning strategy notes, trader scripts, macro research. We need to decode this paralysis. Why is everyone so afraid to move? We're going to extract the critical line in the sand levels you need to watch today, and we need to figure out the macro verdict hidden in all this data. Because looking at these notes, wait and see, seems to be the only game in town.
It is, but the vibe from these notes is distinct. It's not just patience, it's exhaustion.
The market's tired.
The market is tired. Think about the week we've just had. We've been trapped between the euphoria of this Greenland Relief Rally for 48 hours and now this sudden, sharp reality check from the bond market.
It really feels like everyone is holding their breath. But what is the actual catalyst? Why the paralysis right now this morning?
It's what the institutional desks are calling the liquidity trap. Investors are frozen ahead of next week's FOMC meeting, sure. But more immediately, they're waiting for the revised Michigan consumer sentiment data.
Due later this morning.
Right. And the market has priced in this perfect, smooth, disinflationary glide path. It believes the Fed has stuck the landing. But the data is starting to argue back.
And that argument is getting really loud in the Treasury market.
Precisely. The stakes couldn't be higher. The 10-year Treasury yield is hovering near a breakout. We're at 4.24% right now.
Wait, hold on. Let me play devil's advocate for a second. We've heard about lurking yields for 6 months. We survived 4.50% last year. We even survived 5.00% back in the day. Why should I be scared of 4.30% today? Why is this the number that kills the rally?
That is the right question to ask. The difference is valuation relative to reality.
Okay.
When yields were at 5%, stocks were cheaper. Right now, the S&P is priced for absolute perfection. It's priced as if rates are going to 3.5%. So when yields creep up to 4.30%, the math it stops working. If we close above 4.30% today, that January rally hits a brick wall.
Because the equity risk premium collapses.
It collapses.
Okay, let's unpack that term, equity risk premium. We hear it all the time, but let's make it real for the listener.
Think of it this way. If I can get a guaranteed, risk-free 4.5% return from the U.S. government just for waking up in the morning and buying a bond, why on earth would I risk my money on a volatile tech stock that might miss by a penny?
You wouldn't. Or you'd want to get paid a lot more to take that risk.
Exactly. The premium is the extra money I demand to take that risk. As that safe rate from the government gets higher, the bar for buying stocks gets much, much higher. That's the squeeze we're in.
Got it. So at 4.30% or 4.50%, the safe money just becomes too attractive. Now, let's rewind to the Greenland Relief Rally. For anyone who was, actually working the last few days, markets rallied hard. Why?
Because the EU tariff threats de-escalated under this new Greenland framework.
And we need to stress how big of a bullet we dodged here.
Oh, absolutely. Imagine the panic on Tuesday morning. Everyone thought European cars, wines, machinery, all of it was about to get hit with 25% tariffs.
A full-blown trade war.
The Greenland framework didn't just fix a dispute, it pulled the global economy back from a cliff. That's why the rally was so violent. I saw Mizuho even put out a note saying it reaffirmed a structural growth cycle for 2026.
So that sounds like objectively good news. We avoided a trade war. Why are we hitting a wall today?
We did celebrate for 2 days. But now we're in what you could call a macro compression window. The good news, the tariff relief. It's already priced in.
It's a sugar high that's worn off.
Perfect analogy. It's worn off. And now the bad news is lurking again. We've seen a sharp retracement in yields from Tuesday's high of 4.31% down to 4.24%, which sounds helpful.
Usually, cooling yields are a green light for tech. That's the playbook.
Usually. And today, it is acting as a tactical tailwind. It's why you see the Nasdaq up that tiny fraction. But it's so fragile. If those yields spike back toward 4.5% because inflation data runs hot, the market has zero buffer left.
This leads us to one of the most alarming concepts in the notes this morning. The liquidity trap,
Mm.
or as some traders are calling it, the bull trap.
This is fascinating and really dangerous. The sources are suggesting that what we are seeing is a setup.
A bait and switch.
A total beat and switch. Retail traders, the individuals at home, are reading headlines about peace and tariffs, and they're buying the open. They are chasing the Greenland peace narrative.
But the institutional desks.
The smart money, they're doing the exact opposite. They are using that retail liquidity, that buying pressure, to exit their long positions before the weekend. They see the resistance, they see the yield risk, and they are selling into the strength. The verdict from one strategy desk is explicit. Do not buy the open.
That's a clear warning.
Yeah.
It's not just be careful, it's don't be the exit liquidity for a hedge fund.
Don't be the last one holding the bag.
All right, let's get into the mechanics. Let's talk levels. If we're not buying the open, what are we watching? Let's start with S&P 500 futures, the ES.
The most critical number on your screen today is 6,880.
6880. That is very specific. The notes call this Gann structural support. Now, to me, Gann always sounds a bit like financial astrology.
Fair point. It can sound esoteric.
Can you explain what this actually means without getting out a protractor?
Hey, okay. Think of these Gann lines like the load-bearing walls of a house. They aren't random numbers. They're calculated based on the relationship between price and time. And algorithms respect these lines. If you break a load-bearing wall, in this case, 6,880, the roof, which is the relief rally, comes crashing down.
So if we lose 6,880, the structure fails.
Exactly. If the S&P loses 6,880, the entire relief trade is dead. It opens the door right back to a retest of the January 20th lows. And remember, that was the bottom of the panic selling before the good news broke.
We really don't want to go back there. So that's the floor. What about the ceiling?
Resistance is sitting right at the all-time highs, around 6,986, and then you have that massive psychological barrier of 7,000.
And what are the desks doing up there?
The notes say they are selling premiums heavily.
So selling call options, betting against a move higher.
Basically, yes. They're collecting cash from anyone gambling. The market will break out betting. We just don't have the fuel to break 7,000 before the weekend. They're walling off the upside.
So we're sandwiched between a load-bearing wall at 6,080 and a concrete ceiling at 7,000. That's a tight range. Okay, let's look at the Nasdaq 100. You said it's up slightly, but the notes say it feels top-heavy.
It is top-heavy. The critical level for the NQ is 25,450.
25,450.
And that aligns almost perfectly with the 50-day moving average. In technical analysis, the 50-day is often that dividing line between a healthy uptrend and a corrective phase. Breaking below it turns the short-term trend bearish.
And the dynamic they're describing is interesting. They call it distribution, not accumulation.
That's a key distinction. Even though the index is green, distribution is what happens at a market top. It means the big players, the whales, are selling stock to smaller players without crashing the price yet.
They're unloading inventory while the price is high.
They're handing the heavy bags to the retail crowd. It's a classic sign of a tired market.
And one reason the Nasdaq feels so heavy today has to be the anchor dragging it down. We have to talk about Intel.
Yeah, the elephant in the pre-market room. Or maybe the dinosaur.
Intel is down double digits. Sources are pegging it around negative 11.7% pre-market.
Yeah.
That is a massive move for a company that size.
It feels like Groundhog Day with them. The catalyst this time was Q1 guidance. They beat on Q4, but barely, and the forward-looking guidance was just a disaster.
So is this just a bad quarter? Or is this something structural? At some point, a turnaround story just becomes a decline story.
The consensus in our stack is that this is structural. It's not a cyclical dip. The issue is that enterprise spending is cannibalizing traditional CPUs to fund GPU clusters for AI.
So companies aren't buying Intel's bread and butter because they're spending every spare dollar on NVIDIA.
Exactly. It's a zero-sum game for the budget. And Intel is the ghost of tech past, struggling to adapt. The technicals show that fear. The bull case level is $49.50. It needs to reclaim that to show any stability.
In the bear case.
The bear case is scary. A break below $47 triggers a technical flush.
And a flush means a rapid sell-off with no support, like the floor just dropping out.
Right. If 47 breaks, you could see a quick retest of the 2025 lows. Institutional confidence in their roadmap is just, it's wavering.
Now, if Intel's the ghost of tech past, let's look at someone who figured out the modern landscape. Netflix. Completely different story. Up 4.2% this morning.
It's a totally different narrative. Remember a few years ago, the streaming wars? Everyone said Netflix was doomed.
Because of Disney plus HBO, Amazon.
Well, Netflix won. The sources say they have effectively decoupled from the streaming wars. They're now in a category of one. While Intel is fighting for scraps, Netflix declared victory and went home.
It seems like that ad tier is finally doing the heavy lifting.
That's the key. High margin leverage. The ad tier is scaling, it's generating cash flow. They aren't just growing subscribers, they're growing profitable subscribers. It's a mature, cash-generating machine now.
And then there's the king, Meta Platforms. The relative strength leader?
Meta is a beast. It jumped nearly 6% yesterday and is following through today. The chart is pointing toward blue sky territory, above $660.
Blue sky, meaning no historical resistance left.
Exactly. When you're at all-time highs, there's no one waiting to sell to get back to even. Everyone holding is in profit. No bag holders. That creates pure momentum.
But there's always a risk level.
Always. For Meta, it's $635. If it loses $635, it's a failed breakout, and it could gap down to $615 very quickly.
So we have the old guard crashing, the content king soaring, and the AI giant leading. But I want to pivot. SLB, formerly Schlumberger, an energy play.
And an interesting one, we talk so much about tech, but there's a gold rush happening in energy infrastructure, and Venezuelan crude rerouting, SLB, is breaking out.
What's the level to watch?
$58.20.
Yeah.
If it gets above that, it shifts from a boring value play to a growth leader. It tells you the market is starting to look for hard assets, not just digital ones.
And that transition from digital to hard assets brings us to the most dangerous part of today's deep dive, the pain trade.
This is the part of the show where you need to turn up the volume, because this is what retail investors usually miss until it's too late. This is the scenario that wipes out portfolios.
So define the risk. We know yields are rising, but usually when U.S. yields go up, the dollar gets stronger. That's the U.S. exceptionalism trade.
Usually. That has been the playbook for a decade. But the pain trade, the scenario that keeps fund managers up at night, is the sell America rotation. This happens when the market focuses on the reason yields are rising.
Explain that.
If yields are rising because the economy is booming, that's fine. But if yields are rising because of a fiscal credibility gap, meaning the world is worried about U.S. deficits and sheer amount of debt we're issuing, then the correlation flips.
So instead of the dollar going up,
Yields go UP, but the dollar and stocks go down simultaneously. It's a total vote of no confidence. It's the market saying, I don't care that you're paying me 4.5%. I don't trust the currency you're paying me in.
that's a nightmare scenario. If stocks crash and the cash is crashing, where does the smart money go?
Global value, like Europe or Japan, but primarily hard assets. This is why we are watching gold so closely.
And the notes mention gold is approaching a massive level.
$5,000. It's approaching $5,000. The instruction in the strategy notes is explicitly to watch the $4,950 level.
Why is $5,000 so important? Is it just a round number?
It's psychological, but it's also structural. If gold breaks $5,000, that is a flashing red signal of a risk-off rotation. It means capital is fleeing paper assets, stocks, and bonds for physical safety. If that happens, it negates any strength we're seeing in tech.
So even if Meta looks good, if gold breaks 5,000, the tide goes out on everything.
Exactly. You can't trade Meta in a vacuum if the macro environment is shifting to sell America. If the house is on fire, it doesn't matter how nice the furniture is, you get out.
That puts a serious damper on the week. Let's bring this all together for the listener. What's the game plan for this Friday morning?
The summary is this. The bounce we saw was news-driven, about Greenland. But the reversal we're risking today is earnings-driven and macro-driven. Fundamentals, like Intel's disaster and our debt reality, are trumping the headlines.
So the strategy is defensive.
It has to be. Do not chase the open. Let the market prove it can hold the line.
And those lines, again, one more time.
On the S&P 500, watch 6,880. That is your floor, the load-bearing wall. If it breaks, the rally is over. And on the macro side, the 10-year Treasury yield, the magic number is 4.30%.
If we close above that, next week is going to be very difficult. And keep an eye on gold at $5,000.
Absolutely.
Before we wrap up, I want to leave you with a thought. You mentioned this Sell America rotation. It feels like we're at a crossroads.
We are, and it raises a really provocative question. We've spent a decade accustomed to U.S. exceptionalism, the idea that money flows to the dollar in times of stress. But with gold nearing $5,000 and this talk of a fiscal credibility gap, are we entering a cycle where fiscal deficits finally matter more to the market than the AI growth story?
That's the multi-trillion-dollar question. Are we looking at the balance sheet of the country or the balance sheet of NVIDIA? Because for the last 2 years, NVIDIA mattered more. But that might be changing.
And today, the market might just give us an answer.
Well, the bell is coming. Stay nimble, watch your levels, and don't get caught in the trap. We'll be watching right there with you.
See you at the close.